program is the active center.
Have you ever looked at the stock market and just felt completely lost? You see all those charts and tickers and weird acronyms, and it feels like trying to read a foreign language. You're definitely not alone. But today, we're going to talk about the one concept that can translate it all for you, the idea that really opened up investing for everyone, the mutual fund. Okay, let's dive right in. So, we're going to start with a scenario that I think a lot of us can relate to. We'll call it the $1,000 problem. You know that feeling? You've managed to save up a bit of cash, you're ready to make it grow, but you're just staring at your screen thinking, where on earth do I even start?
So just picture it. You've got that $1,000. It's sitting there, ready to work for you. But then, boom, a whole wave of questions hits you. Do I buy stocks? What about bonds? I mean, what even is a bond? The sheer number of choices can feel absolutely paralyzing.
Now, a common first thought is, okay, I'll just pick a couple of big-name companies I've heard of. But think about that for a second. Imagine you put your entire $1,000 into just two stocks. One has a great year, fantastic. But the other one gets hit with some bad news, and its stock just plummets. Just like that, half your investment could be wiped out. It's a massive gamble that, let's be honest, most of us just can't afford to take.
But thankfully, there is a much, much smarter way to play this game. And it's a concept that has totally revolutionized investing for everyday people. And that is, of course, the mutual fund.
So what is this thing really? At its heart, a mutual fund is a really simple but powerful idea. It's basically a company that takes money from lots of different people. We're talking hundreds, sometimes thousands of investors, and pools it all together. And then it uses that big pile of money to go out and buy a huge, diversified collection or basket of investments. You know, my favorite way to think about it is like an investment potluck dinner. You bring your $1,000, someone else brings $5,000, another person brings $500. If you were on your own, you could probably only afford a couple of simple dishes. But when you put it all together, suddenly you've created this incredible feast with dozens of different things to try, and everyone gets a piece of it all. So let's break down how that potluck actually works. Step 1, you and a whole bunch of other people chip in your money. Step 2, a professional fund manager. I mean, this is an expert whose full-time job is to research this stuff, takes all that money and buys hundreds of different assets. And then, step 3, and this is the magic part, with that one single investment you made, you now own a tiny little piece of every single thing in that giant fund.
And that brings us to the absolute core strength of a mutual fund, instant diversification. You're not betting your future on just 2 or 3 companies anymore. Your risk is spread out so thin that if one company in the fund goes under, it barely makes a dent in your overall investment. Now, of course, that professional management isn't free. They charge a small annual fee for their expertise, which we'll get to later, called an expense ratio. But here's the thing, not all mutual funds are the same, not by a long shot. Just like a restaurant menu has appetizers, main courses, and desserts for different tastes, the world of mutual funds has all kinds of options designed to fit different financial goals. Let's look at the 3 main categories here. First up, you've got equity funds. These guys invest in stocks and are pretty much the growth engines of a portfolio. They come with higher risk, for sure, but they also offer the potential for bigger long-term returns. Then, in the middle, you have fixed income funds. These buy bonds, and they're all about creating a steady, predictable stream of income, generally much safer than stocks. And finally, you have money market funds. These are the most conservative of the bunch, investing in super safe short-term debt. Their main goal is really simple: keep your original investment safe. Okay, here's something that trips people up all the time: the difference between a money market fund and a regular old savings account at your bank. They're both considered really safe, but there is one critical difference you have to know. Your bank savings account is FDIC insured. That's a government guarantee. A money market fund, while very, very low risk, does not have that same government guarantee. That's a key distinction. All right, so you get what mutual funds are, and you know about the different flavors they come in. But the big question is, how do you pick the one that's right for you? Well, it's really all about matching the fund to your own life and your own goals. And this, right here, is the most important question. It's not about finding the quote-unquote best fund that's out there. It's about finding the best fund that lines up perfectly with your specific goals, and, just as importantly, your comfort level with risk. And it really all boils down to 2 key things you have to ask yourself. First, how soon do you need this money? Is it for a house down payment in 5 years or for retirement in 30 years? That's what we call your time horizon. And second, how much sleep are you going to lose if the market takes a nosedive? That's your risk tolerance.
So if you've got decades to go until you retire, you can generally afford to ride out the market's ups and downs. That makes funds that are focused on stocks, like equity or growth funds, a really great choice. They're built to chase higher potential returns over that long run.
But, on the other hand, if you're saving for a short-term goal or you're just a more cautious person by nature, then safety becomes the name of the game. And this is where those lower-risk options, like money market and fixed income funds, really shine. They're designed to protect your initial investment and provide stability.
So what if you're not at either extreme? You want some growth, but you also want some safety. Is there a fund for that? You bet there is. Meet the hybrid option, the balanced fund. A balanced fund is kind of like a pre-made portfolio all-in-one. It gives you diversification across different types of assets. So a typical one might hold about half its money in stocks for that growth, maybe 40% in bonds for stability and income, and then keep a 10% cash cushion in a money market. It's an all-in-one strategy ready to go.
Okay, we have covered a ton of ground here pretty fast, so let's just pause and lock in the most important ideas. If you only remember 3 things from this whole explainer, I want it to be these 3 points.
So here it is, the whole thing in a nutshell. Advantage number 1 is instant diversification. It's the smartest way to manage your risk. Advantage 2 is professional management. You're getting an expert in your corner. And finally, the cost. You got to remember that this professional service comes with a price tag, and that's the expense ratio. It's usually a small annual fee, but it's so important to know what it is and how it can affect your returns over time.
Look, at the end of the day, a mutual fund is more than just some financial product. It's a tool. It's the tool that gives a regular person with even just a little bit of money access to the kind of portfolio that used to be only for the super wealthy. It makes real investing possible for everyone. So the question is no longer if you can invest. The real question is, what are you going to build?